I was meeting with long-term clients of the firm earlier this week, and I asked them, do you remember what happened 4 years ago? They had a blank stare, and I had to remind them, 4 years ago was the 4-year anniversary of the market bottom, March 9th, 2009. What's happened since then? Look at these stories. The financial crisis, the European crisis, Hurricane Sandy, 2 elections, $6 trillion in new debt, Obamacare, Bernie Madoff, a number of stories and negative headlines, but equities still persevered. In fact, if you look at the S&P 500 index, on March 9, 2009, 4 years ago, it closed at 676. A few days ago, a mere 4 years later, it closed at 1,551. That's an increase of 129%, and that does not include dividends, meaning your million would have grown to nearly 2.3 million. Look at the EFI index, which is a measure of international large cap companies, still produced an 87% return. How about emerging markets? The MSCI Emerging Markets Index. It increased 113% during that time. And last but not least is the Russell 2000 Index, which covers U.S. small cap companies. It increased almost 175%, which means it almost tripled during those 4 years. Amazing returns, but it was when people least expected them. Those that captured those returns, like our clients at Financial Harvest Wealth Advisors, had to have done 3 things. 1, they had to have discipline and psychological strength to stay fully invested, and even rebalance selling high quality bonds when they were doing well in 2009 during the fall, and actually rebalance into equities which were falling. Number 2, they had to have a strategically allocated portfolio to capture multiple returns across the globe. And number 3 is they had to be working with a fiduciary to have their investment plan putting their interests first. As we always say, remember, your survival and your financial freedom is on the line, and that is definitely shown in the last 4 years for those that captured high rates of return when they least expected them.